All right. Well, thank you. So thank you, Kite and Mir especially, for first organizing this excellent seminar series, and second for allowing me to be a part of it. As I've, by the way, told a number of you, I prefer to do my presentations in a more discussion way. So, please do feel free to interject and ask any questions at any point in time. I absolutely am not committed to getting through all of my slides if you all want to talk about, some of the pieces in more depth. So again, please do, feel free to speak freely throughout this. Now, I'd like to start by first kind of, clarifying the motivation for what I'm presenting here, and also to kind of clarify, where we're going in terms of the sort of main insights I want to convey. So first and foremost, let me say that, the paper I'm presenting today is an economic model of Uniswap v3, essentially Uniswap v3. And so, for the moment, v3 is the latest version of Uniswap. We haven't had v4 quite yet. And so the consequence is that this is essentially, the latest version of the biggest DEX out there. And so my co-authors and I thought it was sort of important enough that, we should dig into it as economists, try to understand it deeply as economists. And so this paper is an economic model. It's got a bunch of results that try to understand, various aspects of it. But there was actually something specific that motivated us first sort of getting into this. There's a particular piece of it that I want to focus on, which is, the main result you're seeing right now, which I'll explain in a moment. But essentially, what we were initially really interested by was trying to understand what it means to be a liquidity provider in this setting. So liquidity provision in general entails an investment, right? Whether it's in a decentralized exchange or a centralized exchange, you ultimately are taking some capital and you're providing it as liquidity, and there's some investment profile that you're going to get from it. And in the context of, say, Uniswap v2, it seemed like most people were fairly clear on what exactly that meant, the investment profile that they were facing. But for v3, at least from the conversations that I had, people had trouble articulating what exactly it meant to provide liquidity in this setting. And so that's something we really did want to understand. And so I'm going to, as you see, anchor the talk a little bit around what we found in that regard. So if there's one thing, that I can convey through this presentation, it's what I have up here as our main result, which is stated a little bit imprecisely here, but I'll make it more precise as we go, and then really precise when we get to the model so I can use math. But essentially at a high level, it turns out providing liquidity in Uniswap v3 is approximately taking a covered call position, okay? And so to make that concrete, first of all, imagine, and I think this will be useful as a working example, think about one of the Ether versus USDC pools in Uniswap v3. We're saying if you go in and you provide liquidity to this pool, what you're approximately doing is investing in a covered call strategy of ETH against, let's call it a numeraire of USDC. Okay? Now, yeah, you don't have to raise your hand, by the way.
Many people will ask you what covered call means.
Hold on. Oops. That's not what I meant to do. So I have that ready to go here, actually, if I can. But actually, let me come to that in a moment. All right, sorry. I'm still acclimating myself to the technology here. So first of all, before I go into like precisely defining that, I want to provide a little bit of intuition for what a covered call is. Okay, so when you think of a covered call, think of taking a long position in a risky asset, but foregoing the upside. Okay, so if we're working with ETH-USDC, a liquidity pool of ETH-USDC as a working example, what I'm saying is you have a portfolio position that is exposed to price fluctuations of Ether up to a point, right? So Ether right now is worth about $3,000. So you could imagine a portfolio position where if Ether goes up $100, I make $100. If Ether goes down $100, I lose $100. But if Ether goes up $1,000, I don't make the full 1,000. Because maybe at about 3,500, I stop being exposed to Ether. And so I only make 500, up to the 3,500, and I don't make the next 500 to 4,000, okay? So covered call, think about long asset position in a risky asset, but sort of truncated, because past a certain point, you don't get it. Yeah.
And there's a premium.
Right. So I'm coming to that. And in fact, it relates a bit to why I say approximates here. This premium is going to be sort of crucial there. So first, what I'd like to do is sort of take Nir's question about really what a covered call is beyond the intuition, what it specifically is. And then I'm going to come back to what you're saying, because this premium turns out to be very important in understanding the notion of the word approximate. Okay. So first of all, you can think of a covered call is actually two trades in the same portfolio. Okay. So one of the reasons why it is a long position truncated is because one of the two trades that composes it is literally a long position. If you want to forget about Uniswap v3 for a moment, if you want to develop a covered call position in Ether, what you would first have to do is literally go out and buy Ether, which is why you end up sort of exposed to Ether for a certain price range. But you don't just buy the Ether. What you do is you sell a call on it. And the call essentially is what's foregoing the right to sort of earn profits as Ether runs up past a certain point. Okay. Now this gets to, I think, what you were saying a moment ago. Sometimes when people sort of think about this, the initial reaction for people who may not have a background in finance or economics is to say, well, this seems a bit weird, right? Like, particularly for somebody in the crypto community who's probably very bullish on Ether, why would I take a position in Ether that like foregoes the upside past a certain point, right? That might strike you as a little bit weird, but the answer is in what was just said, which is that when you sell this call, you actually receive a premium. Somebody is paying you for selling that call. So it's a bit like saying, yes, I know the price could run up, but I want the money now. Okay, so I'm going to forego the future payments that I would get, the future P&L I would get from my long Ether position. So I won't get it at the time, but instead I will take the sort of risk-adjusted present discounted value of all that upside today, right? That's the way a covered call is supposed to work. And so as a consequence, this is actually a perfectly investable portfolio. Right? I know there are a lot of behavioral economics people in the room. A covered call trading strategy is not a behavioral trading strategy. It's a perfectly sort of rational trading strategy, precisely for the reason that yes, you give up the upside, but you do it for something you're paid. You're paid upfront for the upside, and so this is a perfectly investable trading strategy. But remember, I said that the liquidity provision at Uniswap v3 approximates a covered call. I didn't say it is a covered call. And so it turns out one of the key differences is that while the covered call is an investable portfolio position, providing liquidity at Uniswap v3, if you're just getting the P&L from the liquidity, is actually not investable. And the reason for that is exactly this point about the call premium. Okay. So first of all, let me restate this main result now. With a little bit more precision, still no math, but a little bit more precision. So instead of saying it's approximated by a covered call investment, I'm going to say it's dominated by a covered call investment, okay? And the reason why I'm saying it's dominated by a covered call investment is because it turns out the difference is that you are foregoing the time value premium from the covered call, okay? So in other words, it's like saying you're going to forego the upside and not get paid for the risk-adjusted present discounted value for all those paths in which the price actually ran up. Any questions on that, first of all? Yeah.
So you're saying foregoing the time value component? Is there a correct way to think about that? You're not foregoing. I mean, all the option value is sort of embedded in time.
No, well, okay, so there's intrinsic value and time value. So if your call is already in the money,
right.
So you get that.
Right.
You will get that.
So, but then it kind of, a call would be an expression of a probability distribution for a certain period of time. I mean, the purpose of expressing it in terms of an option without time value, doesn't that just become?
So I think.
At that point?
Say again?
Doesn't that just become arithmetic at that point?
I'm not exactly
Well,
following your
the
question.
difference between, you know, if your call is in the money, then it's sort of a moot point, right? Like,
No, so okay, so think about this. So I think part of what maybe I'm being imprecise about, which might be causing the confusion, is what is the time component? What is the window? What is the maturity of the option, right? So like how long do I have before this sort of option could get deeper in the money? And so that's basically your investment horizon. So I'm providing liquidity to Uniswap v3, to a liquidity pool at Uniswap v3. You should ask yourself before the fact, how long do I intend to lock up my capital? So if I intend to lock up my capital for a week, then the point is, you know, how much higher could this get within the week, right? At the end of the week. So you should think about the maturity and therefore the time value as, you know, how much higher could this get in that time that is my investment horizon. Does that help at all?
I'll ask as we go.
Okay. But so, okay, you know, when I, yeah.
Sorry, there's a question up there.
Okay, if he wants to, well, actually, maybe it's just easier if I look at it. Well, let's see, could I repeat the questions? And it is Kite asking. Okay, we'll do in the future, and if I forget, you all can, you know, remind me. Okay, now I'm not sure it was a good idea for me to ask for a lot of questions if I have to repeat them. But at any rate, okay. So one reaction, though, from what I've phrased so far, though, is, well, it depends on, I think, your level of familiarity with that space. Because one reaction, actually, for people who are very familiar is, wait, this sounds kind of familiar. Which is to say, for those of you who are familiar with the phrase impermanent loss, this is a specialization of impermanent loss in this setting. So it is actually very well understood, or very familiar, I should say, to people in the crypto community who have thought about decentralized exchanges, that providing liquidity at decentralized exchanges is a dominated investment, unless you have fees to compensate for the losses that cause it to be a dominated investment. And so the implication, by the way, of what I'm saying, that providing liquidity to Uniswap X fee is dominated by some other investment strategy, does not imply that, you know, Uniswap 3 is useless. What it implies is you need some level of fees in order to make it worthwhile for liquidity providers to actually provide liquidity. And more importantly, it's not a binary thing, right? So if you're an economist, you think about things like welfare. And if you're a financial economist, you particularly think about things like trading costs, right? If we want Uniswap v3 to succeed, then we want trading costs to be low so that people will actually trade there. And what that means is it's not a binary about, well, okay, we'll charge some fee, so we'll have some liquidity provision, so we'll have some sort of reasonable trading costs so we can have something happening. It's more about how do you set the fee to induce a level of liquidity provision that can produce very low trading costs and therefore get a lot of trading activity. So let's see. So there's sort of a second main result that pairs with this first point, right? So the first point is, yes, providing liquidity to Uniswap v3 in the absence of fees is a dominated strategy. It's essentially a covered call option without the time value that you get if you were to actually set up a covered call option. And so we need to essentially compensate people for the fact that they're sacrificing that time value. But then the consequence of that is that liquidity provision, broadly speaking, like total liquidity provision that you can expect at these platforms, ends up being a trade-off of two things. One is fees. The more fees that you're able to generate on these platforms, the higher you will have in total liquidity provision, right? Because these are payoffs that are going to be going to the people who are providing the liquidity. But the more time value you have in the option, the less liquidity provision you're going to get, because it's a cost for the liquidity providers. It's what they're losing. It's telling you how much better they could do if they were to not do this and to set up an actual covered call trading strategy, okay? So don't think of fees as just sort of like, again, some binary thing where like, oh, so we just need some fees and therefore we will have some liquidity provision. Yeah, fine. You have some very small fees and you have some very low liquidity provision. The trading costs will be insanely high and you'll get some very low trading volume. The question is more, you have these two things that are then being traded off. The fees that generate liquidity provision, that incentivize liquidity provision, and the time value that is sort of disincentivizing it. And so you really need to set the fees to balance the sort of time value. And so one of the implications, by the way, that you can get out of this is that if you are talking about an asset that is more volatile, right, where you have more time value, you're probably going to need higher fees, right, because you have more to compensate. On Uniswap V3, you'll have like stablecoin pools. In those, you don't need to have very high fees because you're not losing very much time value. Your question?
Just a complete ignorance about this, but when you say fees, are those fees set or by a market, or are they set by some kind of policy?
So in the current protocol, basically, there are 4 fee levels. I think it's 1 basis point, 5 basis points, 30 basis points, and 100 basis points. And it's just flat on trading volume. And, because of this being a permissionless setting, basically, if there doesn't exist a pool at one of those fee levels in a pair, you can invent it right now. You open up your laptop.
So it's kind of a market then.
It's a very sparse market in that sense, right? Because there are only 4 levels. I mean, in principle, actually, it wasn't initially available to create the 100 basis point level. That was part of, a refinement they made thereafter. But at least, okay, for this talk, I'm going to ask you to think sort of within pool, though. So my point is, like, if you are deciding to provide liquidity at a particular pool, you don't have a say over what the fees are going to be. Does that make sense? So you should just think of it as kind of like a fixed proportion. Yeah.
So the time, I can see 2 elements about the time. First is the price movement of the assets, which can expose you to risk if it's a risky asset. But the second one is about the alternative revenue from doing with the liquidity something else.
So that is subsumed, basically. The way you should think about it is that, all investable options, you should be, okay, yeah. So you need an indifference condition across all investable options, right? So if I pick one, if you're indifferent between what you end up having here from, let's say, an actual covered call, and you're indifferent anyway from a covered call and a standard long position, then you'll transitively be indifferent from this and all that. But so the value of the covered call is not that it's your only alternative option. It's a very clear benchmark that establishes what you need to correct because of the fact that it is a relationship where the trade is dominated, right? So it's in that sense, it's just a useful concept from an intellectual perspective. Okay, so
can I ask a question? So if we think about JIT liquidity provisions, that kind of forgoes this time value things, right? If we were thinking about like just in time.
No, well, okay. So the issue there, yeah. So I mean, in the sense that the jitter is going to jit for less than a block. I mean, it's 2 transactions in a block. So if you are jitting, you don't need to worry about this. But I do think passive liquidity providers are important, right? So one of the issues with jitting is it disincentivizes passive liquidity provision. And if you don't have any passive liquidity provision, actually jitting can in equilibrium have negative effects, because if there's nothing in the liquidity pool to begin with, then the passive liquidity provider is actually, the active liquidity provider, the jitter, is not going to sort of, make up for the lack of passive liquidity in the pool, right? And in fact, here I think it's a good place for me to plug a paper by Agostino Caponi and Rija Gia specifically on jitting, which kind of makes that point that, jitting, even though you might think that it would be really nice to have somebody provide liquidity, a ton of liquidity right before you trade, it turns out this can actually be bad because it disincentivizes the passive liquidity providers. And the way I think you should think about this paper that I'm presenting is more that it's a paper about passive liquidity providers. The way I'm saying it is like, for all of you in the room interested in crypto, who might be interested in sort of taking risk in crypto through liquidity provision at a DEX, like you're going to say, like, look, I'm going to get some ETH and I'm going to put it in the liquidity pool and I'm going to let it sit there so I can accrue some of this trading fee revenue. You have an investment horizon. You're not jitting, right? And for you, what is the trade-off? And what does that imply for overall equilibrium liquidity provision? That's sort of where this paper is looking at things. Does that make sense?
Yes, thank you.
Okay, thank you. Okay, so at any rate, so I just want to summarize sort of the 2 main results that that really the rest of the presentation is going to be structured around, right? Because now I'm sort of going to go into, well, I'm going to give a little bit of institutional context for those of you less familiar with decentralized exchanges, but then I'm going to sort of get into the formal analysis. And so I want to kind of have it clear what the direction is that I'm going to be sort of going towards, which is what am I actually going to be providing the technical details subsequently to explain? Well, basically these two results we've just talked about, right? So first and foremost, as I said, what we really wanted to understand is what is the investment profile that you face if you provide liquidity at Uniswap V3, right? And so what that turns out to be, again, is a covered call investment, but minus the time value. And again, that seems like, well, isn't that terrible? Like this is dominated by a covered call. Well, not really. All it really means is there needs to be fees. And if you really want to then try to understand what overall liquidity provision would be, it turns out, well, we actually sort of derive it exactly, but the high level way you can think about it is that it's going to be increasing in the amount of trading fees that you generate, but decreasing in the time value of the option, precisely because you're sacrificing it when you provide liquidity. And if you want to think about it practically, again, what this does is it sort of aligns with, anyway, a kind of practitioner intuition that we've seen in terms of thinking about what the right fees are for different trading pairs. So if you have, for example, stablecoin pool, you don't need very high fees. You have ETH USDC, you're going to need higher fees, but then you have some really high volatility cryptos that are not even as mature as Ether, where you might need to go even higher on the fee scale to, instead of 5 basis points, maybe 30 basis points or even 100 basis points as it is. So these are the two things, I really want to convey through this talk, and the talk's largely going to be structured around explaining, where these ideas come from. Okay, so before I really dig into it in terms of the formal analysis, let me do like a basic background on decentralized exchanges. So first of all, if you go like, well, what exactly is a decentralized exchange at a technical level? Well, a decentralized exchange is, at a technical level, just a bunch of code, which is deployed on this digital ledger that we call a blockchain, okay? And so when you hear the term smart contract, all that is just a chunk of code basically deployed onto a blockchain, okay? And so just to maybe crystallize that a little bit, I have literally screenshotted some of the code from Uniswap V3. So what you see here is, as you see, function swap, and then there's a whole bunch of arguments which you don't really need to worry about. But the reason why I even just screenshotted this part of the code is you might wonder then, well, okay, so if this is a bunch of code uploaded to a ledger, what does that have to do with me trading? Like, this is apparently an exchange, right? How does that actually happen? Well, so it turns out the way the system is set up, this chunk of code has an address. And in fact, I've screenshotted the address too, which looks like gibberish. But point is, it is an address, which means it's effectively a point of contact. So for those of you who set up digital wallets, you have addresses. The interesting thing about Ethereum is that not only can people have addresses, but chunks of code can have addresses. And why is it useful to have the chunk of code having an address? Well, because when you actually trade at Uniswap, what you're doing is you're calling this function. In many cases, literally the swap function. You are swapping two assets for each other. And the way it mechanically works is you refer to this contract as the receiver of your transaction. And then you say like, well, I want to call that function. So, if you've ever done a peer-to-peer transaction on any blockchain, right, there's a sender and there's a receiver. Well, when you do a trade on Uniswap, what you're doing is you have, again, like the basic transaction structure where you're the sender, but the receiver is the address for the chunk of code. You're identifying that you want to call this function, you want to interact with this chunk of code, and the way you do it is you identify you use the address as the sort of receiver, and then you have to identify which function you're going to actually, interact with, right? So you're just calling functions in the chunk of code, and okay, how exactly that gets done is sort of maybe secondary. But one of the consequences, by the way, of the fact that this chunk of code can have like an address, essentially an identity in the system, is that this chunk of code, this smart contract, can own things in the system. Like the same way you can own some Ether or some USDC or whatever, having an identity in the system through your digital wallet. The chunk of code, the smart contract, whatever you want to call it, also has an identity in the system and also can custody assets. And so, for example, here I've screenshotted from Uniswap's website. This is, from some time ago, but it's basically looking at this smart contract, which is, I should say, to be fair, this is actually one liquidity pool at Uniswap V3, and it is specifically the ETH USDC liquidity pool. And it actually custodies assets. It has a position in USDC and a position in Ether, right? And so here I'm displaying, at the time I took the screenshot, what the positions were. And so you think about like, okay, so great. There's a chunk of code that owns assets. Okay, what does that have to do with trading, right? Well, so the way trading is implemented in these systems is as a spot swap. Okay, so for example, when you talk about buying Ether, you're not paying cash. Like you're not paying, US dollars from your bank account. You're not paying physical notes or anything like that. What you're doing is you are, if you like, trading with this smart contract. And if you're buying Ether, it's giving you some of its Ether, and you're going to give it some USDC. Okay, so just think of it as another person, and you're doing a spot swap where you give it some assets and you get some of the other assets. So you get some ETH, you give it some USDC. That would be buying. Selling would be the opposite. Okay. Now, if that sort of idea of what exactly a trade essentially is clear, then the only thing that you might then be wondering is something like, okay, so how are the terms of trade set? And the terms of trade, that is the prices and the fees, are going to be set mechanically by the code, right? And so, I'll show the specific rules without having to show you any more code. The point of me showing you the code was just to clarify that it really just is, code on a digital ledger. Any questions on this? All right. Okay. So, at this point, though, the two slides just now that I showed you about decentralized exchanges doesn't really explain what's unique about Uniswap V3, or at least what's different about Uniswap V3 relative to V2. What I described on the last two slides, the idea that it's a chunk of code on a ledger that has an address that can custody assets, is true for Uniswap V2 and for V3. The distinguishing factor of V3 is what's referred to as concentrated liquidity. Okay. Now, what does concentrated liquidity mean? Well, it means that when you provide liquidity, you can say, I only want my liquidity to be used for trades in this price range. So if you provide liquidity to Uniswap V2, it has uniform liquidity, which means you actually don't specify a price range. Whatever you provide it is applicable to be used to intermediate trades at any price level in that pool. In V3, you can say, no, I only want my liquidity to be used when the trading is in this range of prices. Okay? And one of the things that then happens is that depending on where you're willing to provide liquidity, it changes what the composition of the liquidity is. So remember, if we're going to talk about, let's say ETH versus USDC as a working example for a pool, the smart contract holds both ETH and USDC, and it's getting it from the liquidity providers. So when you provide liquidity, you have to provide some composition of ETH and USDC, but you might wonder, well, who decides what that composition is? And it turns out it depends on exactly where you're providing the liquidity. So specifically, it depends on whether you're below the money, at the money, or above the money. That is to say, whether you're providing liquidity below the current price, at the current price, or above the current price, right? So if you want to provide liquidity below the current price, you will have to provide it only in it's called the stable asset, USDC. If you want to provide liquidity above the money, you're going to have to provide it only in the risky asset, Ether. And if you provide it at the money, you actually have to provide a specific mix depending on exactly what the price is. Now, words are always sort of more to take in. So let me offer you a picture, if that helps at all. So imagine, this is a stale picture, clearly, given where prices are right now. But, imagine the price here is a little bit above 2,500. So 2,500 Ether, USDC per Ether. If you wanted to provide liquidity down here at 2,400, you would provide only USDC. Okay. And if you were to provide liquidity up here at 2,600, because it's above the current price, you would provide it in only Ether. The only case where you provide a mix, which will be specified depending on the exact price, is if you are providing liquidity in the price interval where the current price happens to be. Okay. So again, when you provide liquidity, you provide it in terms of the assets that are being intermediated. So if it's ETH USDC pool, you provide ETH and USDC, but the exact composition in terms of ETH and USDC is determined by where the price is relative to the liquidity you're providing. You had a question?
To clarify what you mean by taking a step back, providing liquidity means that you are willing to make an exchange for a specific allotment or unit. You're willing to sell that in exchange for the other one at any price below that threshold, except for the one where it's mixed. And then the inverse of that for above that threshold, you will do the opposite.
What, no, so let me clarify. So there's sort of two roles in play, right? There's a trader and there's a liquidity provider. So the liquidity provider is providing the smart contract with assets, ETH and USDC. And I'm saying, so it's, think of it as like a one way. You're giving in both. You're giving. You may the composition of ETH versus USDC that you give depends on where you want it to be used. So, for instance, if again, let's say the price here is just a little bit above 2,500, and you say you are willing to allow your assets to be used to intermediate trades, right around that current price, then it's going to require you to give a certain amount of ETH and a certain amount of USDC. Because the market is going to, the market might have to go either way, and so you have to provide some. You have to provide some of each in case people want to buy or sell, right? Whereas if you are saying no, I only want my inventory that I'm giving the smart contract to be used. If the prices are way down at 2,400, then it's going to say no, okay, then just give me USDC, okay? And if you say like, okay, my inventory should only be used to intermediate way above, then it only give me ETH. But that's distinct than the actual trading, right? So if I'm a swapper, then I'm doing this thing about, I'm buying ETH, so I get a price and I have to, I'm going to get some ETH from the smart contract and give it USDC. Does that?
Yeah, so I guess just the idea of providing liquidity here is that
you give the smart contract, you give the smart contract ETH and USDC. Did you have a question?
Yeah, similar question. So like the first question is who are the liquidity providers, but I think it's in the legal things or like so you can either like as a holder any type of digital currency, you can either be a trader, just like you simply swap, and you can or you can provide liquidity. Is that correct?
Well, so I think the hope here is that liquidity providers will be just long-term investors who want to take positions, risk positions in the underlying assets, right? As a practical matter, there's some issues with it related to like the JIT question. But yeah, so think of a trader as distinct from from a liquidity provider. Think of a liquidity provider as somebody who basically wants to maintain a portfolio position that is at least partially long in the risky asset. And this is a way to do it in a way you get some yield because you can get trading fees from the traders. And traders are more people who actually, want to go in and out and do things. But think about passive liquidity providers like, I'm going to hold some ETH anyway. Why don't I just throw it in here? And then when you guys want to trade, I get your fees, right? Like, yeah.
So I mean, just so I understand, analogous to other markets, I'm assuming it's the same. The point of providing liquidity is that there are other parties that need to borrow, in essence.
Traders. These are liquidity demanders, right? So yes.
Okay. I want to make sure that's the
No. So that's exactly right. Yeah. So you're a liquidity supplier. There's some liquidity demanders who are the traders in this context, and you want to make off them. So the idea is, yeah, look, I could just hold a bunch of stuff by myself, but then I wouldn't be able to make money from other liquidity demanders. I'm going to provide the liquidity, and so I want to earn something from these liquidity demanders, these traders. Yeah. Any other? Oh, you have one?
Yeah. So the second question is about the price. So like you're saying, like there can be like above money, below money, or at money, but like that would be depending on the current price. But like when you're trying to write the smart contract, so first of all, like is that like above, below, or is that just like our own terrorized like outside of the smart contract, or is that like something embedded in the smart contract? Does that make sense?
No, it does. So there is a mechanical. So there is a mechanical price that the contract realizes every point in time based on actually the amount of inventory that's in it, okay? And so it's going to have a notion of price, which will hopefully become a little clearer when I show you a little bit more of the mechanics. But the point is there are intervals that have been specified to begin with. So for example, there are a few different settings they have, but like one of them, for example, every 10 basis points, there's another interval, okay? So you should think of these bins as sort of exogenously coded in the structure of the contract, right? And then it's just like, oh, where is the current price? Well, the current price is inside one of the bins. So call that the at the money bin. And that bin is going to need to have both ETH and USDC, because essentially you can have two-way trading, and if you have two-way trading in the bin, you need to have assets on either end, right? So yeah, the bins are exogenous and code in the structure of the contract. The current price is going to move around, but the contract in its state will always have a sense of what the current price is based on actually the total amount of inventory in the whole thing. And whichever bin it's in, that's at the money. Whichever bins are below it, that's below the money, and whichever bins are above it, that's above the money. Yeah.
So it's basically a series of ETL statements like.
No, it's not. That gets into the exact execution of it. It's not like an insane amount of if-else statements. But the important thing to understand is that this is so the structure of the intervals is exogenously coded in, and you can think of the price as a state variable that the system keeps track of. So it can always do the exercise of like, well, which bin is this in? And so it can tell then, oh, you want to provide liquidity way below the money. Well, okay, so you need to give me your liquidity as 100% USDC, or you're probably way above, you need to give me your liquidity as 100% ETH. You have a...
Yeah, we're just gonna go back and talk about
Yeah, perfect. No.
Is the only reason why you wouldn't provide liquidity unconditionally, let's say over all prices, because you don't plan to continue owning the underlying thing if it is beyond a certain threshold?
So that's actually a very rich question, but I partially want to push it back, although we do have something to say about it, which is easier to say when I show you the map. But let me sort of try to engage that at a high level just to get at what you're saying. So when do you think you get fees? So because you said, why don't I provide liquidity everywhere? Okay, tell you what, the price of Ether, actually today I think is closer to 3,000. Again, this is old. But do you want to provide liquidity at 50,000? What are you going to get if you provide liquidity at 50,000? Well, no, what I was saying is, when do you get fees?
When someone
Trades at the price interval that you selected. So the way you should think about it is, if you're going to provide liquidity everywhere, there's liquidity that you're effectively providing at 50,000 that is not being provided at the current prices. So you are basically foregoing some trading fee revenue by apportioning some of your liquidity way at the end. In fact, the intuition behind concentrated liquidity was like, wait, why are we providing liquidity at prices that will never be reached ever? What if we concentrate the liquidity where the price is? We will get much better price impacts, right? Now, that's a very sort of like nice intuition. It has the one big issue, which kind of came up in one of these stablecoin depegs after Silicon Valley Bank collapsed, and USDC had $3 billion there, which depegged it. So they have stablecoin liquidity pools like USDC versus DAI. And exactly for this reason, what happens is they are really tight, like just like a few basis points around par. Now, if USDC falls 10%, right, you have now gone out of a few basis points around there. And in a concentrated liquidity DEX, what turned out to be the case then is that there was zero liquidity where that was trading. So it's very nice to think about, well, yeah, like why would we put liquidity at a place where there's no trading, right? But there's no trading this second. What if you have a shock that jumps the price over there? Then you can have some problems with concentrated liquidity. And so it's really more of it is something that requires thinking, I think, in terms of the design of it, because actually, come to think, we have a lot of behavioral people in the room, right? Like this is like, think about how people think about tail risk. They go, yeah, it's never going to happen. Like the USDC is never going to lose 10 points in like a minute. Maybe it will, right? And if you're going to provide liquidity out there, maybe that's what you're betting on. You're going like, you know what? There's like a really small probability this price is going to jump over here, but I'll be the only person getting fees. So
also there is kind of a competition next to the current price, because if I'm a liquidity provider and I want to collect all the fees, so I want to have like epsilon range next to the current price, which guarantee that I will take the fees before Ravi, if Ravi set it 3 epsilons.
So remember, you can't provide epsilon because you're basically choosing the bins. But so you could, the equivalent of what you're saying is I'll just provide liquidity at the money. But the problem is, what if the price moves? You know, there's a liquidity pool. I think the 1 basis point liquidity pool has a step size for these intervals, which is 1 basis point. What if it moves 1 basis point? Now you're providing liquidity that's now idle, right? And so now you have to think about things like readjustment costs, and do you really want to do that, right? So these are actually sort of exactly the kind of questions that, you know, I would imagine Uniswap has to be thinking about. But yeah, so I don't. But by the way, to be honest, like part of the reason of writing this paper was the model actually is sort of built to deal with data in practice. And so one of the things we were hoping to do afterwards, not in this paper, but probably in a follow-up, was to start to think more concretely about how you would want to tune the parameters for different liquidity pools. Because it should already be clear that you would want different, for example, fees for different liquidity pools, because, for example, the time value of the option differs for a stablecoin pair versus, you know, a risky asset stablecoin pair, et cetera. But you know, we haven't quite gotten down to the actual piece of figuring out the exact or doing the optimal calculations. We do have a model which I think you can, you know, use for those purposes, though. Yeah.
So the price of trades when they take place eventually determined just by the composition of coins inside Uniswap, or also by some external?
No. So it's only inside. And you know, one of the funny things is you all might wonder how this sort of graph shifts. Well, so what's basically going to happen? So imagine you're inside this bin, right? And suddenly, okay, so the usual trigger is something like this thing has a static price, right? It doesn't know what's going on in the world outside of it, right? But imagine it's initially aligned with what's happening at Coinbase. And then suddenly the price at Coinbase runs up, right? The price at Coinbase runs up to 2,600 just suddenly. What's going to happen is there's an arb, right? Because this thing still thinks it's over here, and Coinbase is at 2,600, right? So what's going to happen is a bunch of people are going to go, wait. I will buy from this thing at this low price, and I will sell it to Coinbase at 2,600. Free money, arbitrage, right? But what happens when people buy here? Remember, the buy is a spot swap where I get ETH from here, and I give it USDC. So now look at this bar. What happens if I take away ETH, reduce the red, and add USDC? So how does it know the price, by the way? Well, imagine doing that exercise. This bar is going to become more and more blue, and at some point, it's going to look like one of these bars. At that point, this thing knows that the price is now here. So it actually knows the price by the ratio in the bin that it thinks is at the money. And as soon as it gets to like, oh, it's all USDC, oh, I'm right here. And so now if you want to trade, if you want some ETH, it's going to go that way. If you want some USDC, it's going to go that way. And the moment, let's say you want some ETH, because I said the ARB was at 2,600, this bar is now going to look like this until, you know, people keep going through the ARB, and it's going to keep on pushing through like that. So that's how it knows the price. It's basically, this is the at the money bin, this is the composition, and if it keeps going one way, eventually it knows it's in the middle of 2 bins, and then, you know, it can keep on figuring it out that way. Does that make sense?
Almost.
Okay.
But I'm not in the comments. I apologize.
No, of course.
So what does these bars mean? So as soon as I put money, I don't know what it means to put money in a bar. Immediately when I put the money, it changes the price, right? It slides even a little.
Okay, so think of it this way. I have an array that where the sort of the thing that it's an array of not a primitive data type. So and I basically keep track of the holdings, if you like. Yeah, so think of each of these bars as it is one smart contract, but you can think of through using that array, you can allocate the inventory to each of these bars. So think about each of them as owning a separate amount, right? And so when you come and trade with me, right? When you come and trade with me and you want to buy some ETH, I'm going to decrement I'm going to decrement my overall balance because I have an identity in the system, and I have to decrement that because it's coming out of the system. But I can like ascribe, if you like, the reduction to this part.
I think of these as order book. Each entry here, such as says it's sell and buy price, or it's price.
It's not really an order book. So okay, I guess what I'm getting at is, okay, so is it clear that the overall smart contract has a custody of a certain amount of assets, right? But now the point is if you like look across this whole picture, this picture implies a certain total custodying, right? Like I sum up all the amount of USDC and the all amount of ETH, that corresponds to some amount of ETH and USDC, which has to align with the custodying for the smart contract, right? So I'm saying you can do a mental exercise where you say like, yeah, okay, this contract is custodying all these assets, but I'm going to identify it with intervals. So I'm going to say, even though there's no sense in which it's like, different entities owning it, I'm going to have an array that basically keeps track of index 0 owns whatever, 10 USDC. Index 1 owns 12 USDC. Index 2, I don't know what number it owns how many, right? So I can keep track of that, right? And so the point that I'm making is that when I actually do the trade to reduce the amount of ETH that I have and have more USDC, I can ascribe it to this index, right? So I just have to have, that's not exactly how it's done, but the point is I can just ascribe the inventory to each of these intervals. And then as long as I know, for example, as long as I am keeping track of what this ratio is, I can know what the price is. It's a bit more bookkeeping in the sense that ultimately the identity in the system is the contract, and the contract has the custody of the total set. But there's a sense in which the custodying, the sort of the inventory is broken down by these intervals. Okay, maybe we can talk afterwards. Well, this also ends up being like a useful concept in the math. So maybe that'll help when I show you some of the math. But okay, so let's maybe talk about sort of the formal economic analysis. So we're trying to think about this from the perspective of passive liquidity providers. And so for a passive liquidity provider, the idea is you actually are going to park your capital, right? Like you're going to own some ETH anyway, and you're going, why don't I get some yield on it by providing liquidity, by getting something from the liquidity demanders, the traders, right? So we're going to sort of fix your investment horizon. You have some T amount of time where you have some capital that you want to park, right? And so at the beginning of your investment horizon, you have to make an investment decision, okay? So we're gonna assume that you rationally make that investment decision. And we're just going to normalize that time to t equals 0 because who cares what you call it exactly. Now, why are you making that investment decision in the first place? Why are you providing liquidity? Well, because your hope is that in the time that you leave your liquidity there, a bunch of people are going to come and trade, and you're going to get some money for it, right? So essentially, in between this sort of initial time 0 and when you are going to pull your liquidity at capital T, there are going to be some liquidity traders that arrive. We're going to assume this happens randomly, as in life. But this is why you're doing it, right? You wouldn't just provide liquidity if nobody's going to trade in the first place, because then it's a waste of your money. But so intermediately, you're going to have liquidity traders coming in randomly and trading. Now, they're not the only kind of liquidity. They're not the only kind of traders who are going to trade, because when prices move at the when prices move at the centralized exchange, or any centralized exchange, when prices move, say, at Coinbase, it opens up arbitrages, right? You need an alignment between prices at, say, Coinbase and Binance and Kraken, et cetera, and what this thing says prices are. And if there's a misalignment, you're actually going to have arbitrageurs come in, and this is going to be costly for you, but this is something you need to internalize, like as a practical matter. In fact, anybody who's thinking about providing liquidity to DEXs, if it's not clear already, you are going to face arbitrage trading against your liquidity, and it's something you need to internalize. So we're going to internalize it in the analysis. And then, of course, at the end, you need your capital, so you're going to liquidate the position, right? And so your hope is, so you're going to have some sort of P&L owing to the fact that the portfolio of assets are going to be fluctuating owing to trading, and you're also going to get some fees from the trading, right? And the whole point is, if you're a rational investor, you're going to internalize sort of how much you expect to gain from the fees, and how much you expect to gain or lose from the fluctuations in the prices. Okay, So we're just really doing the exercise of thinking, okay, if you're a rational investor and you can internalize sort of what's going to come before you, how are you going to make your investment decision at the start? Okay. And one thing that's important to understand, because we're talking about concentrated liquidity here, is that your investment decision is not, do I provide liquidity or do I not provide liquidity? Your investment decision is, if I provide liquidity, where do I provide it? What prices? You can provide no liquidity whatsoever, but if you say you're providing liquidity, are you providing it here? Are you providing it here? Are you providing it here? And how much here? And how much here? And how much here? Right? That's the decision. The decision is how much for each of these bins, if you like. So the thing is, there are sort of key distinctions, like limit order books do not have the persistence of the commitment. So for example, like if I put an offer in on a limit order book and the price trades through me, I'm out of the limit order book. And if the price crashes back down, I'm out. Like let's say I put an offer, at $4,000 and the price of Ether shoots through $4,000 in a limit order book. I have made $4,000. And if the price comes back down to 1,000, I'm fine. I still have my 4,000. If you provide liquidity at 4,000, and the price of Ether shoots through 4,000 and comes back to 1,000, you have lost all that money. You have a commitment in providing liquidity to a liquidity pool that you do not have to a limit order book. You also have an issue of, there's also two-way liquidity that's essentially at play here, right? Like if I provide liquidity here in this bin, my inventory is being used if the price goes up or if it goes down. That's not the case if I put an offer in there. So incidentally, I have a paper with a couple of people who are really sort of, actually one of these co-authors, Joel Hasbrook, is my co-author on this paper, and he's also a co-author on this other paper, which actually sort of explains why they're not the same thing. They are getting closer. So concentrated liquidity is closer to a limit order book than uniform liquidity, but they're still not the same thing.
So the fees.
Well, so fees can get very sort of involved, right, in centralized settings. And yeah, the fees are very simple in decentralized exchanges. So yes, that's another distinction. But okay, so if you're going to, let me come back here then. So if you're going to sort of try to internalize what's going to happen when you provide liquidity, like in expectation as a rational investor, then you have to have some sense of kind of how the world evolves. And specifically, you're going to have some sense about how you expect prices to move. Because remember, actually, you're going to face a loss to the extent that there's time value in the option, right? You're also going to face losses to the extent that there are arbitrage traders who are going to see misalignments. And so we're going to have to make an assumption about how prices move, which is, a fairly standard assumption in finance. So this is, a stochastic differential equation. I guess I won't spend too much time on it other than to say it says, prices can go like this. You can fit it to the data however you like. But the point is, I want to emphasize this price specification that we have here is a price specification for, if you like, the value of the asset according to public information. So the value at Coinbase, you can think of it as, okay? And why am I saying the value at Coinbase? Because the liquidity pool, the decentralized exchange, again, is a chunk of code on a blockchain. It has no idea what is going on in the real world directly, okay? So we cannot say it follows this process because the actual price, according to the decentralized exchange, as I said earlier, is a function of the inventory it owns. I cannot just say it follows some process that I see in the data. But the price at Coinbase does follow some process. And the key point is that to the extent that the price at Coinbase deviates from what the decentralized exchange thinks the price is, that creates an arbitrage, and that's actually what drives alignment in practice, okay? So we're modeling this price just because we understand that arbitrageurs are going to arbitrage it against the current price, and therefore it's going to affect the current price. Yes?
Can I challenge that? Because I feel like if I'm a big liquidity provider and I have some inside information that I feel that Ethereum going to have a big announcement today about moving to staking or whatever. So I can kind of adjust and say, okay, I will withdraw my liquidity because I feel that tomorrow they're going to be a Wild West or.
So I don't think that's I don't think that affects this. So all I'm saying here is that there is some true value process for there is some price given public information, which I'm saying, practically speaking, think of a price at a centralized exchange where they can literally see what's going on and choose their prices on the basis of it. And I'm saying mechanically, the code has a price based on what it says. So I don't think what you're saying changes either of those things, right?
Just thinking about.
So the only thing I would say is that the public information you're describing would probably also affect how Coinbase is pricing things. But that's subsumed by this, right? So in other words, we have a Wiener shock here, which is negative. I don't know what direction you say.
Just feel like it's a more philosophy question because Andreas said the paper that he said like what's going to happen in a world that we only have decentralized exchange and no centralized exchange. We have no like spot price.
Yes.
So I think like in this world, the liquidity providers sometimes can adapt their liquidity in a way that they have inside information and they don't look on the spot market.
Okay, so that's totally fair, but I think you're thinking of a world that doesn't quite exist yet, right?
Yeah,
So you're saying if there's no centralized exchange, then what is the price discovery process going to look like on this decentralized exchange? And I totally agree. You know, that is actually, so that's a very interesting and important question for when we think about whether we want to use these sorts of things in traditional markets, because if you use them in traditional markets, then maybe you won't have the centralized exchange, you know, to arb against. So that's definitely a very interesting and important question. But I will also say it's also, for the moment, counterfactual, right? And so here we're looking at things kind of with the fact that, you know, centralized exchanges do exist. But I think that's actually a very important question, again, for people in traditional markets to think about with regard to whether they should replace their limit order books for this. Yeah.
Just want to make sure I understand that in the liquidity provision side of things, what you described as arbitrage is the attraction to relatively good fees. Is that correct understanding?
Wait, say that again?
You mentioned arbitrage
Yes.
on the liquidity provision side of it, like that. Is that?
Yes. So I did mention that, but so
that's due to. I mean, that's due to relatively attractive fees where liquidity is not being provided by others.
No. So the arbitrage is happening because there's a misalignment in prices between, say, Coinbase and the liquidity pool. And this is actually bad for liquidity providers because what I'll show you in if I get there is that you're basically picking off the liquidity providers. Like it's the liquidity pool that has the wrong price. And so you're basically trading with them at stale prices. And so you're picking them off essentially. And so it's very bad for them. And in some sense, fees actually help because they create limits to arbitrage, as in they make it less likely the arbitrage will happen. But anyway, so in equal, you know, so where this is the price process for the centralized exchange, if you like, or for any sort of anything that's outside of the DEX that's able to incorporate public information. Coinbase is a perfect example. But as a consequence, in equilibrium, what you're going to have is arbitrageurs that are basically going to drive the price of the DEX to the price that reflects all public information. And so part of what Nir was talking about was kind of like, yes, given that the centralized exchange exists, the price discovery will probably happen there because they can actually see what's happening. And then the decentralized exchange reflects the price only because the arbs are opening up. But he was saying, well, what if there's no centralized exchange? What will the price discovery process look like at the decentralized exchange? Because it wouldn't have anything to adjust to. But anyway, here, you know, Coinbase exists, so we're modeling, we're involving that in the model. Okay, so yeah, there are two kinds of traders. We already talked through this. Quickly, let me say, so what does concentrated liquidity mean in the model? Well, it basically means that there's this step size delta where basically any price level, let me take a step back here. There's a price grid that defines the liquidity pool. And the meaning of the price grid is that you can provide liquidity to any interval characterized by adjacent values in the price grid. Okay. So this is sort of like something that is in the smart contract itself. You're essentially taking all prices and you're cutting them up into intervals that partition the full space. And you're saying you can provide liquidity to any of these intervals or all of them or whatever. You can choose how much capital you want to provide to every interval. You could provide no capital to any of them. And this is what differentiates V3 from V2. In V3, you can't say, oh, I'm only going to provide liquidity between 1 and 1 plus delta. No, you're providing it everywhere. And when I say you're providing liquidity to an interval, what it means is you're providing liquidity for trades at prices within the two values of the interval, okay? So you're saying, oh, I'm providing liquidity at, you know, $4,000 to $4,010. You're saying if the price is trading at 3,000, you can't use my inventory for that, okay? I'm only providing it between 4,000 to 4,010. If you're trading at 3,000, you can't use my inventory. If you're trading between 4,000 to 4,010, you can. And so this is just sort of a formalization of saying, you know, that you can do that. You can restrict your liquidity to certain price ranges, okay? Let me see. And so just to remind you, this is what I'm talking about. They're intervals that are sort of defined in the contract, if you like, and you can provide liquidity to as many of them as you like and as much as you like in these particular intervals. You cannot, for example, provide liquidity in a subset of an interval, and you're not compelled to provide liquidity for all intervals as you would be in V2. Okay? Any questions on this? Yeah. It varies. Like, for example, for stablecoin pairs, it looks very flat and there are only a few bars because people don't provide liquidity very far out. But a lot of them are, I mean, the risky, risk-free can get very close to symmetric, but you know, not this nice. This is just me making numbers up. Yeah.
Is default or counterparty risk exist in this world?
No. So these are like spot swaps where you're literally, you know, you're flipping custody through lines of code that either are all going to execute or not going to execute. So there is a certain sense which you could introduce that, depending on exactly what you mean by that, but I don't think in the sense that you probably mean that that's an issue. Okay. So I'm. No. So you're saying, why am I saying that there's a sense in which it's not? So I mean, like, if you are to fork, like the fork on the Ethereum blockchain, right? Yeah. So that's why I was saying I don't think he actually means that. So my answer is not really, but kind of. Anyway, so okay, let me skip this. This is just explaining the pricing, which you've probably seen in other lectures anyway, and you know, it's whatever. The thing I really want to get to with the sort of negative time I have is, okay, so how should we think about this as investors? So the way you should think about it is, for every interval I, because remember, you can provide liquidity just for intervals. That's what V3 introduces. It's not there in V2. In V3, you can say, like, that price range, I'm providing it only for that price range. Every interval corresponds to a portfolio, because every interval has some composition of ETH and USDC that it owns. And so I can think about the portfolio value per interval. So the I is the interval, right? So it's like this width, right? You can pick this one as an example, or this one or this one. I'm saying this width corresponds to some inventory, and I can talk about the portfolio value of that inventory. And it's the one that I'd be interested in if I'm providing liquidity to this one, right? So I'm going to define it here, right? And so all it is the USDC plus the ETH times the price of ETH, right? Because the value of the USDC is 1. So implicitly, it's USDC times 1 plus ETH times the price. So this is the total value. And you say, like, okay, great. Why do I care? Well, the reason you care is because it affects your return. What is your return? Well, your return is your portfolio return. How much does this portfolio value change over time, right? So the value of this portfolio at capital T at the end of my horizon divided by the value at 0, the initial start, plus the fees, okay? And the point is that you have other options that you could invest in, okay? So the way a rational investor thinks about this is there's some payoff I get. There's some sort of risk-adjusted return I get from this, right? This is just an expectation this is a risk-adjusted expectation of the return that I defined on the previous slide. That return should be aligned with other investment options. And so picking one that we classically pick in finance is the risk-free rate. Once you risk adjust, I should get in expectation the same return as I would from the risk-free rate. But it turns out that if you impose that, I can derive the equilibrium liquidity provision in each interval. And it ends up being kind of intuitively exactly what you would expect, which is it ends up being the total fees divided by the opportunity cost. The more fees I get, the more I'm going to invest. And the larger the opportunity cost, the less I'm going to invest, okay? What is the opportunity cost? It's going to turn out it's exactly the time value of that call option I was talking about earlier, okay? Okay, so model solutions. Let me maybe skip some of this stuff and just jump to kind of a formalization of what I was discussing at the start. So it turns out that if you think about the step sizes as being really small, that the return from your investment without the fees is this thing. And you go like, well, what the hell is that? Well, think covered call. You're long a spot. So let's say I'm long Ether. I bought Ether and I sold a call against it. So how should that look in terms of a payoff? Well, if I hold some Ether, then I get the price of Ether, right? And if I sell a call option, well, I should get the negative of the call price. So that's all this is saying. This is saying that the terminal payoff from a covered call is holding the risky asset less the intrinsic value of the call option, meaning the value of the call option without maturity, because at payoff, there is no time left in the call option. And so that's fine. But if you look at the expression I had on the previous slide, it said that the return from this investment is actually the payoff from a covered call, which is in the numerator, right? Long the spot, short the call. The call doesn't have any time value at this point because you're at the end, but it's divided by the value of a spot asset less also the intrinsic value of a call, which is to say it's saying that you're initiating the trade by paying the price of the ETH less the intrinsic value of a call option, not the time value of a call option. So when you sell this call option at the start, you're actually not getting what you're supposed to get. All that huge, the run up that will happen with some probability, you're not getting paid for it because this is the intrinsic value, not the time value. Okay. So the point is this return, which we derive in the paper for investing in Uniswap V3 is off from the return from a covered call just by what's read here. If it was actually a covered call, the thing that's read would involve time value, and it doesn't. It is just the it's just the intrinsic value, as we say. And so this again is really a manifestation of what's called impermanent loss. And so it says you need some fees, okay? And so we also derive then what equilibrium liquidity provision would be, which, you know, this expression might be a little complicated. So let me just sort of state it differently here. What it's really saying is liquidity provision is proportional to fees and inversely proportional to time value. Proportional to fees, let me skip that. What I want to focus on is this. So that expression, if you check it, it is that the liquidity provision is proportional to 1 over this expression. What is this expression? This is a call option with time t left in it, the actual fair value of a call option with time t left in it. And this is a call option with time 0 left in it. A call option with no time left in it has no time value. It's just the intrinsic value. And this is with the time value. So this is exactly capturing the time value. And so it turns out liquidity provision is exactly inversely proportional to the gap between a call option with the time value and a call option without the time value, right? So time value has a negative effect on liquidity provision. And so, for example, if you have a higher vol asset that you have in the pool, you're going to have a higher time value and therefore lower liquidity provision. And so maybe you should compensate more with these fees, right? That's the point. Okay, there's some stuff about if you want to implement this in like the Black-Scholes case, which I will skip since I am, you know, over 5 minutes over time. And I'll just then again remind you. So there are 2 key points here in terms of V3, right? We're saying on the one hand, XV liquidity provision is essentially a covered call, but you don't get the time value. So you really are sacrificing the upside without getting anything for it. And the consequence of that is that when you think about equilibrium liquidity provision, that is the total amount of liquidity provision, you need to balance this cost with the fees that you're offering so that you can get some decent level of liquidity provision and therefore get some low trading costs so we can actually have these things succeed. And if you want sort of, you know, the details, since I sort of rushed through this at the end here, this is the actual paper. It's joint with Joel Hasbrook at NYU, Thomas Rivera at McGill University. And I have a very convenient tiny URL here, which you can just type in now to pull it up. And, you know, it's V3 paper. But so with that, thank you for humoring me. And thank you for your questions and your comments.